We're in Denver, Colorado at EnerCom's 19th annual Oil and Gas Conference. I have the pleasure of welcoming John Brawley, the CFO of Miller Energy Resources. Hi, John.
Hi, nice to see you.
Miller Energy is focused on Alaska. What are the risks and rewards of operating in Alaska, John?
Well, we love operating in Alaska because it's a very favorable environment for us. We get funded partially by the state. We get 35 to 60% of everything we spend back from the state. We operate in the Cook Inlet and on the North Slope, and we're very excited about operating there. Not only do we get state tax credits, we also have a great commodity price environment where we receive ANS, which is similar to Brent-based pricing, and we receive long-term fixed prices on our gas at prices in the $7 per MCF range. So the commodity price environment is great, tax environment is great. Our team's been operating there for a long time, and we think Alaska is a phenomenal place to operate.
You mentioned the Cook Inlet. Tell us more about your operations there.
In the Cook Inlet, we have three distinct fields, plus one on the North Slope that we've recently announced as an acquisition. The three fields that we have consist of the Redoubt unit, which has the Osprey platform, which has an offshore component. We also have the West McArthur River unit, which has production from West McArthur River and Sword, where we'll be drilling our Sabre well shortly. And then we have the North Fork unit on the other side of the Cook Inlet on the Kenai Peninsula that's a gas field, which we acquired in February. Then last, also on the North Slope outside of the Cook Inlet, we announced that acquisition and will hopefully close pending regulatory approval in December.
John, talk to us about your asset acquisition strategy.
We've been very aggressive in purchasing assets this year. We acquired the North Fork gas assets on the Kenai Peninsula in February, and we recently announced the acquisition of the Badami field owned by Savant up on the North Slope. So we care a lot about having infrastructure in place, having producing reserves, and making sure that we're maintaining cash flow and providing additional development upside. We act quickly when we see something we like and beat a lot of our competitors by being nimble.
Purchasing rigs is part of your development strategy. Could you talk about the benefits of owning and operating rigs?
So in most places, folks don't like to own their rigs, like in the lower 48, because there are plenty of rigs available to be leased, and it makes sense for them to lease them. For us, there's significant mobilization costs to bring a rig up to Alaska and then winterize it and get it ready for Alaska conditions. If we lease a rig, we have to spend all the money mobilizing it, winterizing it, and then the rig company keeps those modifications and keeps the rig. So for us, if we can buy a rig that's already up there cheaply, we can save a lot of money. Typically, the payout is 1 to 2 years on us owning a rig versus leasing it for that period of time. So we have purchased two rigs recently, Rig 36, Rig 37. Again, like all our other acquisitions, we're opportunistic and look for great deals, and we've done that very well and now own all the rigs we need to drill the things that we have. So we're in good shape.
Could you talk about the capital markets and your balance sheet? How do you plan to fund future development and24
From the balance sheet perspective, we have a revolver that we put in place with KeyBank at L plus 300 to 400. We have 24 million available under that. As we grow, our borrowing base will grow and we'll have more availability. We also are receiving 30 million in tax credits from the state in September. So between the tax credits and between the revolver, we've got ample liquidity. We also this morning announced a preferred equity offering where we'll raise about another 15 million in preferred. So historically we've funded through preferred, through tax credits, and through our revolver, which provides us liquidity. So now we're in the best liquidity situation we've ever been, with 55 million in near-term liquidity just from the tax credits and the revolver, and another 15 million coming from the preferred, which puts us up to 70 million of near-term liquidity. So we're in good shape from that standpoint.
Well, John, we wish you continued success.
Thank you very much. Appreciate it.
I'm Quinn Nguyen for oilandgas360.com.